Good morning, everyone, and thank you for your support and your interest in KKC. KKC was launched to give investors access to KKR's world-class global credit capabilities, and it invests in high-yield bank loans and private debt using the KKR's access to deal sourcing and underwriting. KKC is designed to provide an above-market income over time and capital appreciation. Our aim is to deliver a yield of 4 to 6%, and due to the strong credit skills of the team, a total return above that at around 6 to 8%. Jeremiah is going to talk through the strong position of the portfolio, but I just wanted to take a minute to talk to you and make sure that everyone's aware that we're working hard to close the discount that KKC currently trades to the value of the underlying assets in the portfolio. In May, we announced a change to a monthly dividend and an increased distribution amount, giving unit holders a 4.8% yield if they purchased at the initial issue price of $2.50 or 5.3% at the current unit price. In September, we reset our buyback program after successfully completing a $20 million buyback in May and June. We've done this to provide better liquidity, support the closing of the discount to the NTA, and because we think it's a very attractive investment on behalf of the unit holders that benefits unit holders. Since announcing the new buyback in September, we've been active in the market every day for between 15 and 50% of daily volumes. We recently announced that we intend to bring an unlisted credit fund to the market in the first part of next year, hopefully in Q1. This fund will also have the ability to buy KKC stock on market. And that's the latest step in a number of programs that continues to expand the potential buyer base of KKC beyond that initial investor base at launch. Increasing the engagement with investors regarding the opportunity that KKC represents, particularly at the discount that is trading to the underlying value of the portfolio, has been a really large part of the work the local team here in Australia has been doing and will continue to be our big focus for 2022. However, managing the portfolio is more important, and I'll hand over to Jeremiah Lane now to talk through an update of the portfolio as well as an outlook for credit markets.
Great, thanks, Nick. If you could go to page 5, Saskia. The first point that I just want to make is that the returns that we've generated in the underlying portfolio to date have been strong. They have been above our benchmark, and they have been consistent with our expectations for the portfolio. If you look at the 1-year performance, it's been exceptionally strong as we were taking advantage of assets that were for sale at low prices in the pandemic disruption. And since inception, all the way on the right-hand side of the page, you can see that we have outperformed our benchmark for the time since inception. Importantly, on the bottom part of the page, you can see that the duration of our portfolio is substantially below the relevant benchmarks. Duration is a measure of sensitivity of asset prices to changes in interest rates. We sit at the start of what we expect to be a significant Fed rate hiking process, and it's important to have low sensitivity in your asset prices to that process, and that is how we position the portfolio. And then finally, I would highlight the yield to maturity of our portfolio at 7%. We can achieve the return objectives that we have laid out for all of our investors in KKC just with the yield to maturity of our existing portfolio, and we continue to find good opportunities to rotate the portfolio and reload our ability to earn that interest. Saskia, if you could go to the next page. This is a snapshot of our portfolio today. And I think the punchline is that the portfolio that we've created is very similar to the portfolio that we set out to create when I was on the road about 2 years ago in Australia. 90% of our portfolio is senior in the capital structure. That is how we set out to make it. The majority of our portfolio is floating rate exposure. And that floating rate exposure will go up as we continue to add to our exposure to European direct lending, all of which is floating rate. Our asset type is very similar to what was expected. We are primarily focused on bank loans. We do have some high yield exposure. And again, that focus on bank loans continues to tick up as we deploy our European direct lending strategy. You can see our exposure to the different ratings classes, which is as we expected it to be. And then finally, our geographic exposure, we're more heavily focused on North America than our end state. And again, that just reflects our ongoing effort to deploy the European direct lending fund. If you could go to the next page, please. Here we've laid out our deployment of European direct lending. We closed into the European direct lending fund in September of 2020. That's why you see the initial jump up in exposure to that strategy. And then since then, we have just been following our expected process. We see a large number of opportunities. We are very selective about the opportunities that we pursue, and we're continuing to tick up our deployment of that fund. Today, about 40% of that fund is deployed, and 45% of KKC overall is committed to that fund for a deployment of a little less than 20%. We have incremental commitments that are made that are not yet funded that will take deployment above 50% in the coming months. If you jump forward a few pages, I'll focus on how we see the market opportunity. The asset classes that we are focused on, high yield and leverage loans, continue to be the only asset classes where you can earn a significant return following the very broad recovery that all markets have had since the onset of the pandemic. All of the other fixed income asset classes that we follow that we could be invested in offer substantially lower yields, and just as importantly, if you jump forward to the next page, offer much greater sensitivity to changes in the underlying interest rate. So here we've showed the duration of each of these other asset classes and the yield that they offer, and you can see they offer lower total yields and they offer substantially more exposure to changes in interest rates. We simply think you don't want to be exposed to those asset classes. The asset classes that you do want to be exposed to are leverage loans and high yield, and that is where we focused our traded credit strategy. Similarly, we can achieve similar rates of return in the European direct lending book, and as we rotate from traded credit into European direct lending, we expect that to be comparable to or accretive to the returns that we're generating out of the portfolio. If you jump forward 2 pages, I would just highlight the changing nature of where we see opportunities in the market over time, which is one of the core features of why our opportunistic credit strategy has been so successful over such a long period. On the left-hand side of the page, you can see that early in the pandemic, those pink bars at the bottom, those are investment grade. We were pivoting into investment grade. It was very low risk, but it offered high return, and it was a great place to find attractive risk return when the world was very uncertain. Fast forward to later last year, and the opportunity set changed. You can see on the right-hand side of the page that higher quality assets recovered very quickly, while CCC assets recovered more slowly. We were big participants in that lower end of the quality spectrum in that period, as we were interested in harvesting some of the opportunity that the market was giving us. This is core to what opportunistic credit strategy does, is rotation among asset classes as the opportunity set changes over time. Finally, I'll just leave you with the last page of our presentation, where we detail how we've done our outperformance versus our benchmark in different market environments. One of the questions we're hearing a lot from institutional investors is that the easy money has been made. The returns that were available when the world was disrupted are gone, and questions around whether or not we can continue to have success in this market environment. And so what we've tried to show here is that in these calmer markets, and I would point you towards the period of 2017 and 2018, or the period between 2011 and 2014. These calmer markets, we've had tremendous success outperforming our benchmark as we continue to just pursue our discipline, focus on durability of cash flow, downside protection, looking across a huge set of opportunities and distilling those down to a small number of opportunities where we have the greatest conviction that the risk reward is skewed very much in our favor.